The views and opinions of this program are those of the host, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading.
For over 95 years, we've set the bar. Power, we restored it. Protection, we reinvented it. Record yields, we redefined it. If there's one thing we know at FS, it's that just because something hasn't been done, doesn't mean it can't be done. We're never satisfied unless we take your farming operation to the next level. Run your equipment at peak efficiency and bust the bins this season. Visit fssystem.com.
Well, as the dust settled on the trade action Wednesday, we saw a corn market that really didn't want to do a whole lot. Soybeans under pressure. We saw more pressure in the crude oil market, too. I know that's going to be a point of discussion today. A little bit of late buying in cattle trade. I know we'll bring that up as well. Joining us here for our market analysis today, we welcome in Mike Zuzolo with Global Commodity Analytics. Mike, great to talk with you. I hope you're doing well.
Doing great, Jesse. Thanks for having me back, sir.
Well, no doubt a lot of things for us to talk about here today. I think for starters, we have a WASDE report in front of us on Thursday. We're going to get to that. But obviously the Middle East situation between Israel and Hamas was a big talking point early in the week and really has set this crude oil market flying around. And I know that's a place that you wanted to start here today. So let's talk about that a little bit, Mike.
Yeah, Wednesday's trade, I think, was a gap-filling day. We had, as you say, we launched and blasted off on Monday after the weekend news of the Hamas terrorism. And, you know, we're starting to, in the analytical world, trying to piece the puzzle pieces together here. And is it like 1973, which what you're seeing there is the cover of an October issue in 1973 of war in the Middle East. And this has been going on so long that it's very hard to kind of get an analog year or some type of year that would make sense with what we're dealing with right now. Except, Jesse, I think we have a situation developing here where the Hamas terrorists, the aggressors, are really ready for a bigger conflict, and in fact have said as much. There was an Economist article out just today, and one of the bigger leaders in Hamas said they want a rebellion. I will call it what I learned in college in the 1980s when this was going on back during the mid 1980s, and that's another analog type year. This is probably the beginning of a new jihad when it comes to what they're trying to accomplish. I think this is where both Israel and both Hamas and Lebanon and by de facto Iran want to annihilate one another. And so I think it's different in respect to what we went through in the 2000s. It's probably more akin to the 1970s and early 1980s. The reason I'm going down this path analytically is because consumer price indexes in 1973, 1974, when Carter was president, we had high inflation, was around 12, 13%. Inflationary pressures in the early 1980s when Reagan was in place, high interest rates, Paul Volcker actually coming in to slay the interest rate beast during this time period back in the early 1980s. Another time when Israel took on Lebanon and took on Hamas. CPI around that time period was anywhere from 10 to 14% area. So we do have some analog time periods. And the reason I bring this up is because what happened today in the market pulling back makes no sense to me unless you're talking about algorithmic trading and computer trading. I think we're just at the beginning of this hill that we're getting ready to climb in terms of potential upside in crude. And I would liken it pretty similarly to the Ukraine-Russia invasion. Once it starts, it could come on very, very quickly as far as upside price pressures.
Well, let's talk a little more on crude here, and let's go down this path that you're talking about, because looking back at history, I know, as you mentioned, going to the 70s could be a very big key time period for us to look at. And I know you gave me a chart here today as well, looking at the 1973 crude oil price chart. So let's cue up the time machine, go back a little bit here, Mike, and walk us through what we saw here, and then let's parlay that into what we're seeing right now.
Yeah, we really had a big blow up in the Yom Kippur War with Israel and five other Arab nations. I would say that that's kind of what I'm looking at as my model here in terms of the potential size and scope of this war. Part of the reason markets went down on Wednesday was that Saudi Arabia said they were going to try and keep the peace. They were going to keep the oil supplied. Well, you also have Russia, you also have Iran, you also have Jordan, you also have Egypt, Qatar, and the UAE. Most of those nations I just rattled off are more pro Arab than they are pro West. And it's because they are more pro Muslim, their own religion, than they are more pro Jewish or Christian. And that, I know I'm oversimplifying it, but that's what gets us to where we see these price spikes in the early 1970s, because Saudi Arabia essentially got ticked off at us for supporting Israel. They put on an oil embargo, and to move from $4 to $10 a barrel in a relatively short price time period, or $11 a barrel between 1973 and late 1974 doesn't seem like much, but that's about a 300% increase. And so I don't think it's hard for me to envision, say, between the time period of the early 1970s we're looking at, and then going to mid 1983, that it went from about $3 a barrel to $30 a barrel. So you're talking about 1,000% increase in the price of oil. And I think it's not hard for me to envision a 20% or a 40% price increase in terms of price spike in the real time of today's trade.
Well, what's been interesting with today's trade, Mike, and I'll flip over charts here. You know, we just saw crude that was at high levels, and everyone's talking $150 a barrel of crude, and then we fell apart. And then as soon as Hamas launched their attacks, then we saw a bit of a rally in crude to start the week. So, walk me through kind of what you are seeing currently. It's just been a very interesting, wild dynamic, I feel like, in this crude oil market the last couple of weeks.
It really is. And I think what we're seeing between the US bond yields and what they're doing to countries like the United States and the European Union, not to mention what they're doing to the emerging markets who are battling enormous inflationary pressures and running huge debts and deficits to try and battle our interest rate policy. We also have China not coming back around. And so we've got two very big features out there of recessionary pressures. And I think that's what the last 2 months have been about in this crude oil monthly chart, as we made that peak up around $95 back during the August time period. And then the market just completely washed out. And essentially what we did in 5 months, and that's what's interesting about these supply driven, war driven rallies. And that's what I mean about how this could really light up potentially and really move fast on us, is what we did in 5 months from essentially the time period of, or I guess this is a weekly chart. So what we did in 5 weeks, I should say, or 10 weeks, we have eroded most of that in 1 week. And so now we're sitting back at this mid 80 area, wondering if we're going into a big recession, Jesse. And I think that's where what I did today, and what I'll develop more for the clients and subscribers in my analysis, is that my overvalue going through the end of this year was $100 a barrel. That's if China came on board, really was starting to kick into higher gear. And my undervalue was around $75 a barrel, and stayed around $70 a barrel when I updated it today. But I did raise the overvalue number from 100 to 120, gave myself another 20% increase in price from my original overvalue level in case this does become a bigger regional war. And so looking at this chart, my expectation would be that we could go from $80 to $85 a barrel oil to upwards of 120 in a relatively quick period of time, depending on how fast this unfolds and how violent it gets, and especially how many Arab nations come in that are OPEC related to hurt the oil supplies.
If we end up doing something like that, a quick follow-up, do you feel like crude would be supportive to the grain complex if we got up to around $120 a barrel crude oil, Mike?
I do think that. I think that the ethanol margins are strong enough. I think the biodiesel demand and the jet fuel demand is strong enough. And the prices, quite frankly, especially in the corn and wheat, are cheap enough that they would follow. And we saw that Monday. Wheat was the leader to the upside. Bean oil was the leader to the upside when the crude was rallying. they were the leaders to the downside on Tuesday when the crude oil was breaking down, and they did nothing, and in fact helped lead the beans into fresh 2-year lows today, and I think in part because the crude oil was going down and filling that gap. The big question really goes back to is if the crude oil spikes, does that take the dollar down and give the commodities even more lift potential? Or does the crude oil go up and the dollar go up and the equities go down? And that's the footprint of recession and very weak consumption. And if that's the case, then what rallies we get in the commodities, led by a theoretical rally in crude oil, we'd want to hedge into it.
We are having a conversation today with Mike Zuzolo from Global Commodity Analytics. He is our guest analyst here on the program. And Mike, we have a WSDA report coming up here on Thursday. Of course, the October numbers. Typically, we could see USDA make some changes. As we look at this broadly ahead of the report, I'll just kind of leave it open-ended for you here. What's your thoughts heading into Thursday with this WSDA report in front of us here for the grains?
Yeah, I was a little bit disturbed by the average trade guess because the yields for corn and beans were a little bit lower than September, and I'm hearing the exact opposite right now, and anecdotally for the most part of the corn and bean belt at this stage of the game, and we are hitting that halfway point in beans and well over a third of the way done on corn, and it doesn't seem like the yields are tapering much at all, and so I think the USDA, number one, has it right in their September report. And I think there's a better than 50% chance they could actually raise the yields back up a little bit in this report on Thursday. And I'm not sure that the trade was ready for that until we started to break lower. But I'm glad that the wheat is about 10 to 15 cents from its major low of 540 in the soft red going into this report, because I still think wheat has the best chance of leading us out of the hole because of Australia, because of Argentina, both of them having drought, because of the EU crop being lowered by co-cereal. They're now 7 million tons lower than USDA September number for the EU 27. So I'm hopeful that maybe the wheat supply number goes down and buffers us and cushions us a little bit if we would see a yield increase in the corn and beans. If that would happen and the USDA doesn't cut the export demand on corn and beans, I think we may be within 5-6% of a major low, and then we just have to kind of run out the clock and get over 50% harvested and see if we can't get some of our export demand back. But we still have the Mississippi River issue, and I'm wondering if USDA is not going to come in and weigh on that as far as cutting maybe soybean exports even more than corn, just because Mexico has been buying through the rail market for the corn side.
And anecdotally on the corn market too, Mike, I mean, corn's looking for something, anything, any sort of fresh news to push it one way or another, because we have just been so range bound, this 480, 485 level for quite a while now, Mike. So it just feels like we're looking for some sort of news, good or bad, for this corn market especially.
I think that's an excellent point. It shows you, and I think signals to you that corn's just a follower. It's going to take its lead off of the beans and off of the wheat. And the one thing that's helped us, I went back and looked at where we were back in the September WSDA. We've essentially lost 10 cents a bushel on corn and almost $1 now on soybeans. And so those funds did unwind that bean corn ratio as I had expected. And I think that's in part because that grain stocks report did show a tighter corn supply. So corn is poised to go higher, I think, especially once the wheat market makes a low. But is that going to be right after this report, or we're going to have to wait until later in the month of October and get farther down in the harvest progress?
Let's move over to livestock. I want to talk about the cattle market first. Saw a late round of buying in cattle on the day Wednesday. Would love your thoughts on that. And then, of course, let's talk feeders too. Pulling up the monthly feeder chart here on our video feed. Walk me through your thoughts in this cattle market after Wednesday.
I think the cash market is supporting us to a degree at this point, Jesse. I think the fundamentals are there on the cash market, and the prices are there, that the futures got low enough that we actually saw, especially in the case of the feeders, we've actually seen the October feeders go about $2 to $3 underneath the feeder cash index. That, I think, is part of it, but I think it's the smaller part of what really happened on the turnaround today, and maybe it could continue into the rest of the week. But we do get fresh livestock numbers from USDA on Thursday, just like we do grains, and I'm really nervous about the export-import data with this strong dollar. But having said that, I think the funds came in and bought on technicals, because this feeder chart, it is really one of those charts you could put up on your wall and say, this is a really almost a clinic on how the technicals work, and the fact that we were able to hold that major high back in 2014 in the feeder cattle market after testing it for now 4 months in a row. I think that gave the funds some encouragement, along with the weaker grain market, to try and buy some of their market short positions back. And this chart, to me, very similar to the dollar chart, very similar to some of the other charts out there, that I would take these trend lines and support lines as essentially face value as far as what the charts are trying to tell you. Because if you notice at the bottom of this chart, that's the stochastic, those two lines that are now just essentially bound together and running one-to-one with one another. We've been overbought, which suggests to a technician there's fewer and fewer new buyers coming in. We've been overbought for all of 2023. We've never had a correction in the stochastics, and that's a real oddity. You'd have to go back and look real hard to find charts that look like this as far as being overbought for upwards of a full year.
And you mentioned cash being supportive too. We're watching though. This feedlot trade is kind of stalled out a little bit here as well, and watching to see what the demand picture looks like. There's a lot of data floating around this cattle market right now. I think a lot of signs that need to be watched very closely here, Mike.
Yeah, I think this is where the exports and imports come back into play, because if we do go into a global recession because of sharply higher energy prices, history would strongly suggest you're going to hurt your meat consumption around the world. They're going to go to something else in terms of protein needs. And I think with the debt levels we're carrying and the way our Federal Reserve policy has been, I would stand by what we've talked about many weeks in a row here, Jesse, that the fourth quarter of this year and the first quarter of next year are our biggest danger signals. And it's one of our best profitability time periods. So even if you don't buy puts, and this is what I did this week, I rolled down puts in soybeans and feeder cattle. Why? Because I'm thinking the crude oil market can go higher. But by the same token, I've got a WSDA report and a recession that's looming out there. And so I've got a floor underneath me. If you don't do something like that, at least keep your marketings current.
And the hog trade, it looked like maybe a little bit of buying of cattle, selling of hogs on the day, Wednesday, late in the session, potentially. Your thoughts on that? And then also looking at Chinese hog futures here, too. Is this an indication of some things to watch in our hog market, Mike?
It is. I'm really nervous, a lot more nervous on Monday than I was last week when I found out that the Chinese futures market fell 4% on Monday. It fell another 3% yesterday. It fell another almost 1% today. It's starting to really go down, and you can see it rolling over here in this Dalian futures lead month chart. And what this suggests is that we are indeed still in the middle of real economic and consumption issues in China. It's not getting better. And that could suggest that they slow dramatically their beef and pork exports, beef and pork imports. And our export market then has to be turned into a domestically fed market. And I think this makes a lot of sense as to why we continue to see the beans and the hogs trade so closely with one another, Jesse, that pork and bean trade that you and I talk a lot about. But I was hopeful that the hogs would support the cattle market as we got into 2024. I'm really rethinking this now that I'm seeing what's happening in China.
Well, Mike, before we wrap it up here today, final thoughts from you. A lot going on in the trade right now. What would you say to folks as they're taking a look at things?
This is the time where what I do, and it helps me, is I say to myself, what hasn't changed? In all the midst of all this stuff happening, Jesse, and what hasn't changed is that the bond yields and the grains are still very much attached to the hip and trading negatively, strongly with one another. And related to that is we haven't made that wheat low yet. And so those are the things that I look at when we go into a WSDA report, and then you throw on top of what's happening in the energies. But I think the market is underestimating the potential upside in energies. Why? Because we are in an algorithmic, computer-driven world, much more than we were 20, 30 years ago.
Mike, great thoughts and analysis as always. If folks want to reach out to you with questions or take a look at your analysis, get a free trial and more, I know they can do all that very easily, can't they?
Yeah, go to globalcomresearch.com and sign up for a trial. Take a look at the product services, or give me a call directly if something that I said today doesn't quite make sense or you need more detail on it. I'd be happy to talk to you.
Well, thanks for joining us once again here today. Mike Zuzolo, Global Commodity Analytics. Have a great one, Mike. We'll talk to you next week.
Thanks, and thanks for joining me in the time machine, Jesse.
I appreciate you bringing it along. Mike Zuzolo with Global Commodity Analytics joining us here for market analysis today on the program. That's going to do it for us here today. Find us online, markettalkag.com. I'm Jesse Allen. Have a great afternoon.